What if I told you that 99% of day traders lose money, while some swing traders have turned $50,000 into $50 million? The psychology behind these numbers will shock you. Today, we're diving deep into the mental warfare of trading and why your brain might be sabotaging your success before you even click buy. But first, pause this video right now if you've ever felt your heart racing while watching charts. Because what I'm about to reveal will completely change how you think about trading psychology. The human brain wasn't designed for modern trading. It evolved over millions of years to keep us alive in the wild, not to make split-second decisions about Microsoft stock, and this ancient wiring is exactly why most traders fail. Welcome back to the channel where we decode the psychology of profitable trading. If this breakdown saves you even one bad trade, smash that like button. It genuinely helps us reach more traders who need this information. Today, we're dissecting two completely different psychological battlefields, the hyperactive world of day trading versus the patient game of swing trading, and the case studies I'm about to share will blow your mind. Let me start with a story that perfectly illustrates this psychological divide. On one side, we have Paul Tudor Jones, one of the most successful day traders in history. On the other, Jesse Livermore, the legendary swing trader who made and lost fortunes by reading market psychology on longer time frames. Both made millions. Both understood market psychology. But their approaches were as different as a Formula One race and a chess match. Here's what's fascinating. Jones built his empire on intraday momentum and risk management, while Livermore famously said, "Money is made by sitting, not trading." Two completely opposite mindsets, yet both profitable. Why? The answer lies in how our brains process different types of stress and decision making. Day trading triggers what psychologists call acute stress response. Your fight or flight system firing hundreds of times per day. Swing trading activates chronic stress management. Your brain's ability to handle uncertainty over extended periods. Paul Tudor Jones mastered acute stress. He developed what he called defensive trading, never letting emotions override his system. In his documentary, he revealed that he'd rather make money being wrong than lose money being right. That's pure psychological warfare against his own ego. But here's the kicker. Jones himself eventually shifted toward longer-term strategies as he aged. Why? Because the psychological toll of day trading is unsustainable for most human minds. Hold up. If you're thinking, but I can handle the stress, you're already falling into the first psychological trap. Studies show that 87% of traders overestimate their stress tolerance. Let's dive deeper into Paul Tudor Jones's psychology. In October 1987, while most traders were panicking during Black Monday, Jones made $100 million in a single day. How? His secret wasn't superior market knowledge. It was superior psychological preparation. Jones spent hours visualizing worst-case scenarios. He called it intellectual paranoia. While other traders were caught off guard by the crash, Jones had already mentally rehearsed exactly how he'd respond. But here's what most people don't know about Jones's day trading psychology. He used what researchers now call micro-meditation. Between trades, he'd take 30-second mental breaks to reset his emotional state. This prevented the psychological buildup that destroys most day traders. Jones also implemented the 5-to-2 rule. For every 5 minutes of active trading, he'd spend 2 minutes in complete mental stillness. This counteracted the dopamine addiction that makes day trading so psychologically destructive. Jones understood what neuroscientists call cognitive load theory. Your brain has limited processing power, like a computer's RAM. Day trading constantly maxes out your cognitive resources, leading to decision fatigue and poor judgment calls. Jones developed cognitive budgeting, allocating specific mental resources to different aspects of trading. 20% for market analysis, 30% for risk management, 20% for emotional regulation, and 30% held in reserve for unexpected situations. This psychological framework separated him from traders who burned out after 6 months. While others operated at 110% capacity all day, Jones maintained sustainable cognitive load that allowed for peak performance over decades. As Jones accumulated wealth, he discovered hedonic adaptation, the tendency for increased wealth to provide diminishing psychological satisfaction. His solution was genius. He shifted his psychological reward system from making money to understanding markets. The result? While 99% of day traders lose money, Jones achieved 28 consecutive years of positive returns. But notice, he didn't just rely on talent. He engineered a psychological system. And speaking of psychological systems, if you're finding this deep dive valuable, make sure you're subscribed with notifications turned on. We release this level of trading psychology content weekly, and missing even one episode could cost you your next breakthrough insight. Now let's flip the script. If day trading is psychological warfare, swing trading is psychological chess. And nobody played this game better than Jesse Livermore. Jesse Livermore made $100 million during the 1929 crash, equivalent to about $1.5 billion today. But his real genius wasn't in market timing. It was in psychological timing. Livermore understood that markets move in waves, and each wave corresponds to a specific psychological state of the crowd. He didn't trade stocks. He traded human emotions on a massive scale. Here's a quote that reveals his psychological edge. "The market is never wrong, but opinions often are." While day traders fight against every small move, Livermore aligned himself with the dominant psychological trend. But Livermore's psychology was complex. He suffered from what modern psychologists would recognize as bipolar disorder, extreme mood swings that mirrored the market cycles he traded so successfully. During manic phases, he would conduct exhaustive market research. During depressive phases, he would withdraw from active trading, allowing positions to mature. This natural psychological rhythm aligned perfectly with swing trading requirements. He couldn't have been a successful day trader because his mental state needed weeks or months to cycle through different phases. Livermore used inactive periods for what he called market meditation, intense mental visualization of different market scenarios. He'd imagine every possible way a trade could develop and mentally rehearse his responses. This psychological preparation allowed him to hold positions through extreme volatility while others panic sold. When the 1929 crash began, Livermore had already lived through every possible psychological scenario in his mind. But Livermore's psychology had a dark side. He made and lost several fortunes because he couldn't separate his trading psychology from his personal ego. Success bred arrogance, leading to massive losses. This reveals the swing trader's most dangerous psychological trap. Success breeds arrogance, and arrogance breeds disaster. Unlike day trading where losses come quickly, swing trading losses can compound for weeks before you realize the damage. Fast forward to 2021, and we see modern swing trading psychology in Keith Gill, better known as Roaring Kitty. His GameStop play wasn't just about fundamentals. It was about reading collective market psychology. Gill held GameStop for over a year while being mocked by traditional analysts. The psychological pressure was immense, but he understood something crucial. Markets can remain irrational longer than you can remain liquid, unless you position size correctly. His secret weapon? Conviction positioning. Instead of diversifying, he concentrated his bets based on deep psychological conviction. This goes against traditional advice, but it's how swing traders create life-changing wealth. But here's the psychological twist. Gill documented his entire journey publicly. This created external accountability pressure that most swing traders don't have, but also provided psychological reinforcement from a community of believers. Gill pioneered community swing trading, maintaining conviction through social validation rather than despite social pressure. His approach required different psychological skills but proved incredibly powerful. The result? He turned approximately $53,000 into over $30 million. But notice the timeline. This wasn't a day trading success story. It required psychological stamina to hold through months of criticism and doubt. Gill's success demonstrates modern swing trading psychology, the importance of information asymmetry in an age of overload. While day traders chase every headline, successful swing traders develop psychological filters to focus only on information that matters for their thesis. Pause here if you've ever held a losing position hoping it would come back, because what I'm about to explain about loss psychology will save you thousands of dollars. The psychology of loss handling differs dramatically between day and swing trading. Day traders face micro losses, small, frequent losses that accumulate psychological damage through repetition. Each small loss triggers your brain's loss aversion system, which evolved to protect our ancestors from life-threatening mistakes. This ancient wiring makes day trading psychologically brutal because you're triggering loss aversion hundreds of times per week. Paul Tudor Jones understood this trap and developed countermeasures. He celebrated small wins with the same emotional intensity that most traders reserve for major victories. He also implemented loss pre-acceptance, psychologically accepting potential losses before entering trades. Swing traders face macro losses, larger, less frequent losses that can create intense psychological trauma. However, they have more time for psychological processing and emotional recovery between trades. Jesse Livermore developed sophisticated frameworks for handling swing trading losses. He viewed each loss as tuition paid to the market university, maintaining detailed psychological journals, analyzing not just what went wrong, but why his psychology led to poor decisions. Modern neuroscience reveals why different brains are suited for different trading styles. Day traders need high dopamine sensitivity. They thrive on frequent rewards. Swing traders need high serotonin stability. They excel with delayed gratification. Research from Stanford shows day traders have 40% higher cortisol levels throughout the trading day. This stress hormone enhances short-term focus, but impairs long-term decision-making. It's like being perpetually caffeinated. Great for immediate reactions, terrible for strategic thinking. The psychological implications extend beyond trading. High cortisol suppresses immune function, disrupts sleep, and impairs memory formation. This explains why most successful day traders are young. It's not about reflexes, it's about cortisol tolerance. Swing traders show lower cortisol but higher baseline focus neurotransmitters. Their brains are wired for sustained attention rather than rapid-fire decisions, but they struggle more with uncertainty stress, discomfort with not knowing outcomes for extended periods. This biochemical reality explains career trajectories. Paul Tudor Jones eventually transitioned to macro investing. Warren Buffett never tried day trading. They recognized their biochemical limitations and adapted accordingly. Let's talk about the hidden psychology of time commitment. Day traders think they're saving time by making quick decisions, but research shows they spend 60% more time thinking about trades outside market hours. It's called cognitive residue. Your brain keeps processing trade decisions long after you've closed positions. Day traders report thinking about trades during dinner, before sleep, and first thing in the morning. This creates attention fragmentation. Your mental resources become divided between trading and personal life, reducing effectiveness in both areas. Day traders often report feeling mentally exhausted even on weekends. Swing traders must live with uncertainty for days or weeks. This requires tolerance of ambiguity, a specific psychological trait that can be developed but varies dramatically between individuals. Jesse Livermore had naturally high ambiguity tolerance, which he enhanced through specific practices. He would deliberately seek uncertain situations in non-trading contexts to strengthen his psychological comfort with ambiguity. But here's the counterintuitive finding. Swing traders report higher life satisfaction despite making fewer trades. Why? Because their psychological energy isn't constantly depleted by decision fatigue. Decision fatigue deteriorates choice quality after making many decisions. Day traders make hundreds of decisions daily. By afternoon, their decision-making capacity is severely impaired, leading to poor choices that often wipe out morning profits. If you're starting to see why psychological alignment matters more than technical knowledge, You're getting the most important lesson in this video. And if you want to discover which psychological profile matches your natural wiring, I've created a detailed assessment that goes far deeper than anything we can cover here. The link is in the description and it could literally change your trading career. Now let's examine the most dangerous psychological aspect, leverage. Day traders typically use 4-to-1 to 10-to-1 leverage, while swing traders use 2-to-1 to 4-1. But the psychological impact is exponentially different. High leverage creates hyperbolic discounting. You overweight immediate potential gains while underweighting future risks. It's the same psychological mechanism behind gambling addiction. The psychology of leverage operates through magnitude effect. Larger potential gains trigger disproportionately strong emotional responses compared to equivalent losses. A 10-to-1 leverage position that could make $10,000 feel psychologically more compelling than the risk of losing $10,000. Paul Tudor Jones understood this trap. Despite having access to massive leverage, he rarely used more than 3-to-1. He said, "Leverage is the devil in trading," but his real insight was understanding leverage's psychological danger. Jones developed catastrophic visualization, spending 5 minutes before any leverage position visualizing worst-case scenarios in vivid detail. This helped maintain rational risk assessment despite emotional pull of leveraged gains. Studies show 78% of blown trading accounts result from excessive leverage rather than poor market timing. The psychology of leverage is literally the #1 killer of trading careers. Swing traders face leverage creep. Gradual increase in position size as traders become comfortable with success. Keith Gill avoided this through conviction sizing, position size based on conviction level rather than available leverage. Let me share a cautionary tale about psychological misalignment. Nick Leeson, who brought down Barings Bank, started as a successful day trader. His psychological downfall began when he shifted to holding overnight positions without proper swing trading psychology. Leeson had quick reflexes for day trading but lacked patience for position holding. When his day trading profits slowed, he began holding losing positions overnight, hoping they would recover. This psychological mismatch led to $1.4 billion in losses. The lesson? Your trading style must match your psychological profile. Trying to force a day trading mentality into swing trading, or vice versa, is psychological suicide. Here's where trading psychology gets interesting. You're not just battling your emotions. You're in psychological warfare against institutional algorithms designed to exploit retail trader psychology. High-frequency trading algorithms specifically target day trader psychology patterns. They analyze millions of retail trades to identify predictable emotional responses, creating false breakouts designed to trigger stop losses. Renaissance Technologies makes money by exploiting predictable psychological patterns in retail day trading behavior. Their algorithms identify emotional trading signatures and position against these psychological errors. When you place a market order, you're signaling either insider information or emotional trading. Sophisticated algorithms interpret urgency as emotional decision-making and position against you. Swing traders have natural protection because their holding periods make entry timing less critical. They can also align with institutional psychology since large funds need weeks to accumulate positions without moving prices. When you swing trade, you're potentially riding the same wave as billion-dollar institutions. When you day trade, you're often swimming against algorithmic currents. Stop here if you've ever wondered why your day trades reverse right after entry. It's not conspiracy. It's psychology meeting superior technology. Let's dive into emotional psychology. Day trading creates emotional volatility syndrome, rapid swings between euphoria and despair that mirror price action. Studies show day traders experience emotional highs and lows 300% more intense than swing traders. Your emotional state becomes synchronized with 5-minute charts, creating exhausting psychological feedback loops. This occurs because day traders develop outcome dependency. Their self-worth becomes tied to immediate trading results. Even the best strategies win only 55 to 60% of trades, meaning negative emotional reactions 40 to 45% of the time. I've coached traders who couldn't enjoy family dinners because they were emotionally drained from day trading. Their relationships suffered because emotional bandwidth was consumed by market volatility. Paul Tudor Jones developed emotional firewalls, specific rituals to prevent trading emotions from affecting personal life. 30 minutes of exercise after market close, shower and clothing change, and never discussing trading at home unless asked. Swing traders experience emotional compression, longer periods of moderate stress punctuated by intense moments during major moves. This is more sustainable but requires different coping mechanisms. Jesse Livermore developed elaborate mental rituals, spending hours visualizing every possible outcome before entering positions. He understood the biggest danger for swing traders wasn't fear or greed, it was boredom leading to unnecessary action. The psychological impact of noise versus signal cannot be overstated. Day traders must filter hundreds of false signals daily, creating decision fatigue and pattern recognition burnout. It's like trying to have a conversation at a rock concert. You exhaust mental energy processing noise. Paul Tudor Jones developed selective attention discipline, literally covering monitors showing irrelevant time frames. Swing traders operate in psychologically cleaner environments. Weekly charts filter noise automatically, but they face signal anxiety, fear of missing important daily developments while focusing on weekly patterns. Here's where swing trading psychology shines. Alignment with major trends creates flow states. You're moving with market rhythm instead of fighting it. Flow states occur when skill level matches challenge level. Day trading often creates mismatch, either too fast causing anxiety or too slow causing boredom. Swing trading allows better psychological calibration. Keith Gill exemplified this during GameStop. While day traders got whipsawed by volatility, Gill experienced psychological satisfaction of conviction paying off over months. This psychological reward creates positive trading addiction, motivation for continued learning rather than destructive dopamine hits from frequent trading. If you're resonating with one psychological profile more than the other, drop a comment below telling me which fits your natural temperament. I read every single comment and often feature the best insights in future videos. The psychology of risk differs dramatically. Day trading creates acute risk anxiety, intense fear focused on immediate moves. Every tick feels life or death because of leverage and time pressure. Swing trading creates chronic risk anxiety, lower intensity but longer duration worry about overnight gaps and earning surprises. It's the difference between a sprint and marathon. Successful day traders develop psychological numbness to small losses but can become desensitized to risk in other life areas. Successful swing traders develop psychological resilience to uncertainty, which improves decision-making everywhere. The brutal psychology of success rates. Only 1% of day traders achieve long-term profitability. This creates survivorship bias anxiety, fear that you're deluding yourself about abilities. Swing trading's 10 to 30% success rate is psychologically manageable. You can rationally believe you might succeed without defying overwhelming statistical odds. Mark Minervini turned $20,000 into $5 million over 5 years using swing trading psychology. His approach centers on specific entry criteria, psychological frameworks removing emotion from trade selection. Minervini's genius lies in psychological preparation. He spends hours creating detailed trade plans before market open, then executes mechanically. His philosophy: trade like a machine, think like a human. This psychological split, mechanical execution with strategic analysis, is easier in swing trading because time separation allows proper psychological reset between activities. Modern trading technology creates different psychological pressures. Day traders compete with algorithms executing thousands of trades per second, creating technological inadequacy syndrome. YTI, swing traders can leverage technology as psychological allies. Automated scanning and alerts enhance human pattern recognition rather than replacing it. The key is understanding your role in the technological ecosystem. Day traders try to out-execute algorithms, psychologically devastating. Swing traders can outthink algorithms by focusing on longer-term patterns machines struggle with. Psychological resilience is trainable but requires different methods. Day traders need psychological agility, rapid mental state shifts, and quick loss recovery. This requires micro meditation, breathing exercises, and cognitive reframing. Swing traders need psychological endurance, sustained conviction through uncertainty. This requires visualization, journaling, and systematic review processes. Paul Tudor Jones used physical exercise between trades to reset mental state. Jesse Livermore used isolation and reflection to process major moves and recalibrate psychology. The psychological impact on lifestyle diverges dramatically. Day trading creates market synchronization syndrome. Your entire life rhythm synchronized with market hours. You wake up thinking about pre-market moves, spend all day in fight or flight mode, then crash emotionally after close. This creates occupational identity fusion, inability to separate identity from work. Swing trading allows market detachment, periods of complete psychological separation. The most successful swing traders can go weeks without checking positions, trusting systems completely. If you're recognizing yourself in one psychological profile more than the other, you're already ahead of 80% of traders who never consider psychological fit. The fact that you've stayed engaged tells me you're serious about sustainable success rather than chasing quick profits. Here's something most traders never consider. Psychological effects compound over time. Day trading psychology creates increasing stress and decision fatigue. It gets harder, not easier. Swing trading psychology creates increasing pattern recognition and emotional stability. It gets easier because psychological skills compound with capital. This explains why Warren Buffett and Charlie Munger gravitated toward longer holding periods. Psychological benefits compound like investment returns. Looking at career trajectories reveals stark differences. Successful day traders often burn out within 5 to 10 years due to psychological exhaustion. Successful swing traders can maintain performance for decades. Paul Tudor Jones recognized this pattern and made a conscious transition from short-term to long-term thinking. His most successful years came after abandoning pure day trading. So, how do you choose the right psychological path? First, assess your natural stress response. Do you perform better under immediate pressure or need time to think? Second, consider lifestyle psychology. Can you psychologically separate trading from other life areas or need constant market engagement? Third, evaluate learning psychology. Do you learn better from frequent feedback or deep analysis of fewer situations? There's no right or wrong choice, only psychological alignment. Paul Tudor Jones chose day trading because he thrived on immediate feedback. Jesse Livermore chose swing trading because he preferred strategic thinking. You need a system that works with your psychology, not against it. The most successful traders design systems around psychological strengths while protecting against weaknesses. This is why copying someone else's system rarely works. You're copying their psychology, not just methods. You need a system fitting your unique psychological profile. Both styles require high emotional intelligence, but different types. Day traders need emotional agility, rapid recognition, and management of changing states. Swing traders need emotional endurance, sustained management over extended periods. Let me share one final case study. I worked with a trader who spent 2 years failing at day trading, losing $50,000. His psychology was completely misaligned, naturally introspective and analytical, but forcing rapid-fire decisions. When he switched to swing trading and aligned with his natural psychology, everything changed. Within 18 months, he'd recovered losses and developed sustainable profitability. The transformation wasn't about learning new technical skills, it was about psychological alignment. He stopped fighting his nature and started leveraging it. This illustrates the most important lesson. Success comes from enhancement, not transformation. You can't change fundamental psychological wiring, but you can build systems maximizing natural strengths. Here's the psychological bottom line. Your trading style must match your psychological profile, not profit fantasies. Day trading attracts people with dreams of quick wealth, but requires special operations soldier psychology, intense focus, rapid decisions under extreme pressure, exceptional stress tolerance. Swing trading attracts people seeking steady wealth building and requires chess grandmaster psychology, strategic thinking, patience with delayed gratification. Conviction under uncertainty. Most traders choose based on marketing promises rather than psychological reality, setting themselves up for failure before starting. Before your next trade, complete this psychological self-assessment. Rate yourself 1 to 10 on stress tolerance under time pressure, patience with delayed gratification, recovery speed from setbacks, comfort with ambiguity, analytical depth preference, social validation needs, attention span and focus, risk perception patterns. Higher scores on stress tolerance and recovery speed might align with day trading. Higher scores on patience and analytical depth likely align with swing trading. But remember, this isn't permanent. You can adapt as you learn more about your mental patterns under real trading stress. Most importantly, never let anyone convince you one style is universally superior. The only superior style matches your psychological profile and life situation. If this deep psychological analysis has opened your eyes to patterns in your trading behavior, I want to hear about it in the comments below. Share one specific psychological insight you've gained, whether recognizing stress patterns, understanding decision-making preferences, or identifying emotional triggers. These revelations help other traders recognize similar patterns. The most successful traders treat psychology as seriously as technical analysis. They invest time understanding their minds like they study market patterns. This psychological self-awareness becomes a competitive advantage because most traders never develop it. While others fight their psychology making emotional mistakes, psychologically aligned traders execute with consistency and confidence. If this comprehensive analysis has convinced you that psychological alignment is key to trading success, then you're ready for advanced psychological training. I've developed a complete trading psychology masterclass going far beyond what any single video can cover. It includes personality assessment tools, psychological training exercises, and frameworks for building sustainable practices supporting long-term success. Details are in the description below. For those preferring free resources, I've created a detailed psychological assessment worksheet you can download to begin mapping your profile. The link is in the description, and completing this assessment will clarify which approach aligns with your natural tendencies. The journey to trading success is primarily psychological. Technical skills are learnable by anyone, but psychological skills allowing consistent execution. Those separate successful traders from those who struggle. Your psychology isn't a limitation to overcome. It's a resource to leverage. The most successful traders build their entire approach around maximizing psychological strengths while addressing blind spots. This requires shifting from trying to become different to becoming the best version of your current psychological self. Instead of fighting natural tendencies, you channel them productively. The market provides opportunities for every psychological type. Your task is understanding your psychology deeply enough to build sustainable and profitable approaches working with natural tendencies. Remember, the market rewards psychological alignment, not psychological heroics. Choose the path fitting your mind, not fantasies about trading success. If this analysis helped you understand your trading psychology better, show appreciation by hitting that like button and sharing with other traders needing this message. Ring that notification bell so you never miss our psychology deep dives. Drop a comment sharing your biggest psychological insight. Subscribe if you haven't already, and remember, successful trading is 80% psychology and 20% everything else. See you in the next video where we'll dive deeper into psychological tools separating consistently profitable traders from those who struggle despite technical knowledge. Keep trading with psychological awareness, and I'll see you soon.